Example 4, impact of inflation using LIFO compared to FIFO. Now, before starting this example, let's do an experiment. When prices are going up, if we are using LIFO and if we are using FIFO, first in, first out, last in, first out, and let's suppose we made 4 purchase, $5 initially and then $10, and we made 2 units worth of sale. Now, if it is last in, first out, the cost of goods sold will be of these two. So the cost of goods sold would be high, and the ending inventory would be these two. So if we are selling the 2 units, so these units will be sold, so the cost of goods sold would be 20, and the ending inventory would be 5 plus 5, that is your 10. But if instead we are using first in, first out, then cost of goods sold would be 5 plus 5, because this is first in, first out. So your cost of goods sold would be low and your ending inventory would be 10 plus 10, that is your 20. So in LIFO, last in, first out, in rising prices, cost of goods sold is higher and ending inventory is lower. In first in, first out, cost of goods sold is lower, but instead ending inventory is higher. Now once we know this relationship, we can continue with this question. Now company L and company F are identical in all respect except that company L uses the last in, first out method and company F uses first in, first out method. Each company has been in business for 5 years and maintains a base inventory of 2000 units each year. And each year except the first year, the number of units purchased equal the number of units sold. Over the 5-year period, unit sales increase 10% each year and the unit purchase and selling price increase at the beginning of each year to reflect inflation of 4% per year. In the first year, 20,000 units were sold at a price of $15 per unit and the unit purchase price was $8. What was the end of year inventory, sales, cost of sales, gross profit for each company for each of the 5 years? Now let's do it for last in, first out. Now for the first year, we had 20,000 units that were sold. So 20,000 into 15 equals to 300,000. And each year the ending inventory is 2000, so we were left with 2000 at the end, and the purchase price was $8. So 2000 multiplied by 8 equals to 16,000. Cost of sales, so 20,000 we sold, each was for $8. So 20,000 into 8 is 160,000. And our gross profit would be 300 minus 160, that is your 140. Now for the second year, our sales will going to grow by 10%. So 20,000 into 10% would be 22,000. 22,000 multiplied by 15, and the purchase price is growing by 4%. So 15 into 1.04. So 22,000 multiplied by 15 into 1.04 is 343,200. Our cost of goods sold for 22,000 goods would be 8 into 1.04, because initially the cost was 8 and this is also growing by 4%. So 22,000 multiplied by 1.04 equals to 22,000, $183,040, and your gross profit would, if you subtract 343,200 with 183,040, you get 160,160. Because the amount we purchased was 22,000 and this is the amount we sold, so we are left with again the ending inventory of 2,000 multiplied by 8, that is 16,000. In the third year again, our sales would be 22,000 multiplied by 1.1 into 15 into 1.04 raised to power 2, because this 15 in this year grew by 4%. In the third year it will also grow by 4%. So 22,000 multiplied by 1.1 into 15 into 1.04 into 1.04 gives you 392,621, and a gross cost of goods sold would be 22,000 multiplied by 1.1. Initially the cost was 8 and it is also growing by 4%. So 22,000 multiplied by 1.1 into 8 into 1.04 into 1.04, that is 209,398. And if you look, this is the amount we purchased and this is the amount we sold, is exactly the same amount. Hence we are again left with 2,000 multiplied by 8, that is 16,000. This process will continue till year 5, and this is for last in first out. Now if we using first in first out for company F, we need to understand that one part of our cost of goods sold would be coming from previous inventory that is cheaper. Hence our cost of goods sold would go down, that will going to increase our gross profit. Now note that if the company sold more units than it purchased in a year, inventory would decrease. This is referred to as LIFO liquidation. Now the cost of sales of the units sold in excess of those purchased would reflect the inventory carrying amount. Now in this example, each unit sold in excess of those purchased would have cost of sale of $8 and a higher gross profit. Now let's see what's happening. So in our first scenario, we sold 20,000 worth of goods at $15, and this is your purchase price. Hence our sales would be 220,000 into 15, that is 300,000. Cost of goods sold 20,000 into 8 is 160, and our gross profit is 140,000, and we are left with $2,000 worth of goods, and the purchase price of them is 8. So we have an ending inventory of 16,000. Now in year 2, because we are using first in first out, the total sales, the unit sales will grow by 10%. So 20,000 into 1.1 equals to 22,000, and our sales would be 22,000 multiplied by 15 into 1.04. So this would going to give us 343,200. Now as far as cost of goods sold is concerned, out of this 22,000 that we have sold, 2,000 would be coming from previous inventory, that is of $8, and 18,200 would be coming from second year inventory, that is your 8 into 1.04, because it is increasing, the price is increasing by 4%. So 18,200 multiplied by 8 into 1.04 will give you 151,424, and this will be 16,000 or 16,000. So if we add both of them up, 2,000 minus 2,000 is not 18,200, it is 20,000. So this would be 20,000 into 8 into 1.04, that is 166,400. So 166,400 plus 16,000 gives us 182,400. So this is your cost of goods sold, this is your sales, and our gross profit would be 160,800. And as far as your ending inventory is concerned, so previously we sold this now and we are left with 2,000 units. Now this ending inventory would consist of 8 into 1.04, because this is your new purchase price. So 2,000 into 8 into 1.04 is 16,600. Now as far as the year 3 is concerned, now at the end of year 2 we had 2,000 units into 8 into 1.04, that is your purchase price, and this is your year 3. This is your end of second year, this is your end of year 3. Now at the end of second year we made 22,000 worth of units worth of sales. So in year 3, this would be 22,000 multiplied by 1.1. So this would be 24,200. Now your sales would be 24,200 into 15 multiplied by 1.04 into 1.04, because 15 is this year's sale price. It grows by 4% and again by 4%, and you get $392,621. So this is your sales. Now your cost of goods sold would be now 24,200, but again we divide into two parts. 2,000 units coming from the end of year 2 and 22,200 units for the remaining part. Now this 2,000 units, the purchase price was 8 into 1.04, and the purchase price for this would be 8 into 1.04 into 1.04. So 22,200 into 8 into 1.04 into 1.04 gives us 192,092, and for this 2,000 into 8 into 1.04 gives us 16,640. If we add them up, we get 208,732. So we have our cost of goods sold. If we subtract both of them, we get our gross profit. And as far as ending inventory is concerned, so out of this 24,200, 2,000 was coming from here, and 22,200 was coming from whatever the purchase we made at this point, and we are left with 2,000, and the purchase price of this 2,000 would be 8 into 1.04 into 1.04. So 2,000 into 8 into 1.04 into 1.04, that is 17,306. So you need to understand, at this point we made 24,200 worth of purchase. We sold 24,200, but out of this 24,200 we sold 2,000 came from ending inventory and 22,200 came from the purchase we made at this point. So we are left with 2,000 units, and this is the purchase price of these 2,000 units. This we're going to continue year 4 and year 5. Now compare the inventory turnover ratios based on ending inventory carrying amount and gross profit margins over the 5-year period and between companies. Now these are your inventory turnover. Inventory turnover equals to cost of goods sold divided by ending inventory. If you look closely, ending inventory remains same for the company using last in first out, and cost of goods sold is increasing. Hence we observe that ending inventory ratio is increasing. But for company that is using first in first out, ending inventory is increasing. Ending inventory is increasing. Cost of goods sold is also increasing. There is increase in inventory turnover ratio, but not as much as for company L. Now this would going to give us this impression that company L's cost of goods sold is increasing for inflation. So it might appear that the company using LIFO method manages its inventory more effectively, but this is deceptive. Both companies have identical quantities and prices of purchase and sales and only differ in the inventory valuation method used. Now, inventory valuation method that is used has an impact on the ratio. So over here, LIFO company is showing better ratio and seems that it is more effective, but in reality, both of them are doing the same job. Gross profit margin is gross profit divided by sales. LIFO method, because both sales and cost of sales increase at the same rate of inflation. The gross profit margin is slightly higher under first in first out method after the first year, because we need to understand that in first in first out, our cost of goods sold actually reduces. Why? Because we are eating away into our previous inventories. So previous inventories are cheaper, which gives us the impression that the cost of goods sold is lower. So if your cost of goods sold is lower, the gross profit margin goes up. So the gross profit margin is slightly higher under the FIFO method after the first year, because the proportion of the cost of sales reflects an older purchase price that is cheaper, and that will going to increase your cost of gross profit. Hence, gross profit margin appears better in first in, first out. Example 5, inventory conversion from LIFO to FIFO. Now, Caterpillar, based in Peoria, Illinois, USA, is the largest maker of construction and mining equipment, diesel and natural gas engine, and industrial gas turbines in the world. Now, we are given data for Caterpillar. Now, over here we have this very important information that if the FIFO method has been used, inventories would have been 1924, 2139 and 2498 higher. So this is your LIFO reserve. And we are also told that in the first year the tax rate is 28%, and in the subsequent, and in 2017 the tax rate is 28%, and in the rest of the year it's 36%. Now, question 1, what inventory value would CAT report for 2017, 16 and 2015? Now, for this we need to know the LIFO reserve. So we are told the LIFO reserve, it's 1924, 2139 and 2498. So it's 1924, 2139 and 2498. Now this is for 2017, this is for 2016 and this is for 2015. Now FIFO inventory equals to LIFO inventory plus LIFO reserve, and we need to understand this relationship. In rising, when the prices are rising, first in, first out, inventory is more than cost of goods sold. So that is the reason why we are adding LIFO reserve. So these are your inventories for LIFO. In LIFO, this is your inventory, and in order to find out FIFO inventory, we need to add LIFO reserve. So we are adding LIFO reserve. Now there is a slight mistake. This is not 1934. This should be 1924. Question 2. What amount would CAT cost of goods sold for 2017-16 be if it had used FIFO method instead of LIFO method? Now, first in, first out cost of goods sold equals to LIFO plus, now cost of goods sold is less in FIFO, so instead of plus we need to have minus over here, and that is change in LIFO reserve. So in the first case, cost of goods sold under LIFO method is 31049, and our change in LIFO reserve is 1924 minus 2139, that is approximate, that is minus 215. So why we are adding this? We are adding this because minus becomes positive. So LIFO COGS minus 215 actually becomes positive, and we have a positive cost of goods sold, and that is higher than the cost of goods sold in under LIFO. So very important. This is a very important point over here, that actually because the change in LIFO reserve is negative, now usually when the prices are rising, the cost of goods sold in COGS is less. But over here, because the LIFO reserve is negative, the change in LIFO reserve is negative, hence we have cost of goods sold that is higher. Now, what does a higher cost of goods sold indicates? Indicates that the earning before interest and tax would be lower. That will going to reduce your taxes. Now, in normal circumstances, in LIFO, COGS is more than inventory, and COGS under LIFO is more as compared to COGS under FIFO. So if COGS is more in LIFO, it means earning before interest and tax is lower, and hence it should have lower taxes as compared to FIFO. This is under normal scenario. Under normal scenario, if your COGS is higher, then it means your taxes are lower, because earning before interest and tax would be lower if COGS are higher. But over here we don't have a normal scenario, because change in LIFO reserve is negative. That has increased our cost of goods sold. If the cost of goods sold increases, then your taxes goes down. Now, what net income would CAT report if it had used FIFO method instead of LIFO method? So FIFO net income equals to LIFO net income. Now, under normal scenario, under FIFO, cost of goods sold is lower, If cost of goods sold is lower, then the net income would be higher. Hence, we will going to add change in LIFO reserve into 1 minus tax. Now over here, net income under LIFO was 754. So 754, that is your LIFO net income, plus change in LIFO reserve minus change in LIFO reserve multiplied by tax. Now this should be 754. Because our LIFO reserve is change in LIFO reserve is negative, we will going to minus 215 minus 215 multiplied by 0.28. Now if you look closely, this equation will be 754 minus 215 plus 60 for 2017. Now in this case, under FIFO, cost of goods sold is higher. So if cost of goods sold is higher, there will be a tax advantage. Now there will be a tax advantage, our taxes would go down. How much our taxes would go down? That is your 60. In 2016, the same case, net income is minus 67. Change in LIFO reserve is 359. You can see it from here. So why we are adding this? Because 2139 minus 2498 equals to minus 359. And net income in LIFO is 754. Because of this special case where your change in LIFO reserve is negative, we are having advantage as far as our tax is concerned, and tax reduction would be 60. That is change in LIFO reserve multiplied by tax rate, and our net income under FIFO would be 599. Now by what amount would CAT 2017-16 net cash flow from operating activities decline if CAT used FIFO method instead of LIFO method? Now cash flow from operations are impacted by taxes. So under FIFO, because our cost of goods sold is higher, we are paying less taxes. So we are paying $60 million less taxes in 2017 and 129 less taxes in 2016. So the effect of using FIFO on CAT's net operating cash flow operating activities would have been increase of 60 in 2017 and increase in 129 in 2016 because we are paying less taxes. So if you pay less taxes, we are going to have higher cash flow from operating activities. And further on, there are approximate incremental decrease in income taxes that CAT would have incurred if the FIFO method were used instead of LIFO method. Now, what is the cumulative amount of income tax saving that CAT generated through 2017 by using LIFO method instead of FIFO method? So, the income tax saving, the formula is LIFO reserve multiplied by tax rate. But over here, we have a very special scenario because the tax rates are changing. So in 2017, the tax rate was 28%. In 2016, the tax rate was 36%. Now, keep this in mind, LIFO reserve multiplied by tax. So in order to find out the amount of income tax saving, so the LIFO reserve for 2017 was 1924. And for 2016 it was 2139. But because there is a discrepancy, because in 2017 the tax rate is 28%, in 2016 the tax rate is 36%. So what we need to do is, in order to find the income tax saving, that is 2139 multiplied by 0.36, this is for this, plus change 1924 minus 2139 multiplied by 0.28, and we get 710. So the cumulative amount of income tax saving that CAT has generated by using the LIFO method instead of FIFO is approximately 710 million. Now what amount would be added if CAT retained earnings at 31 December 2017 if CAT had used FIFO? So FIFO retained earnings equals to LIFO retained earnings plus change in LIFO reserve, LIFO reserve 1 minus tax. Now why are we adding LIFO reserve 1 minus tax into LIFO's retained earnings? We need to understand that in FIFO, in normal scenario, the cost of goods sold in FIFO is less as compared to LIFO. In LIFO, the cost of goods sold is more. So if cost of goods sold is less, net income is more, and if net income is more, retained earning is more. Hence we have an addition sign over here. So the effect or what amount would be added in CAT's retained earnings would be LIFO reserve into 1 minus tax. So LIFO reserve 1 minus tax is LIFO reserve minus LIFO reserve into tax. So what is your LIFO reserve in 2017? That is 1924. So 1924 and minus LIFO reserve into tax that we calculated in the previous question, minus, and that was 710. So 1924 minus 710, 1924 minus 710 would be 1214. What would be the change in CAT's cash balance if CAT had used the FIFO method instead of LIFO method? So in the previous case, we actually calculated what is the cumulative amount of income tax saving that CAT has generated through 2017. Now that was 710, and your cash balance is impacted by taxes. So the effect would be 710. Under the FIFO method, an addition of 710 million assumed to have been incurred for tax expenses. Calculate and compare the following 2017 under the LIFO method and FIFO method inventory turnover ratios, days of inventory on hand, gross profit margin, net profit margin, return on assets, current ratio, and total liabilities. Now these are your ratios. Inventory turnover, that is your COGS over average inventory. Now if you see, inventory turnover ratio is higher than FIFO, so it means under LIFO it's better. If inventory turnover ratio is higher, then your days of inventory in hand would be lower. Gross profit margin is higher again, and net profit margin is also higher as compared to FIFO. Now if you look ratios that are concerning return on assets, now over here LIFO is again doing better. Current ratio is better under FIFO, and total liabilities to equity, it is again better in FIFO. Now let's look at these ratios. Now the first ratio is cost of goods sold divided by average inventory. Now over here, what is happening? Now in FIFO, inventory is higher because of LIFO reserve, and also cost of goods sold is higher because the change in LIFO reserve was negative. So in LIFO, this is your cost of goods sold and these are your inventory. Now your cost of goods sold is also going up and your inventory is also going up. So cost of goods sold divided by average inventory. So numerator is going up and denominator is also going up. Now this factor is increasing the ratio and this factor is decreasing the ratio. But overall, we see that the ratio has gone down. This means that the average inventory went up by a higher amount. Now days of inventory in hand, that is 365 divided by the turnover ratio, inventory turnover ratio. So if under LIFO inventory turnover ratio is higher, then the number of days would be lower. Now gross profit margin is gross profit divided by revenue. Now if you recall, under FIFO, the cost of goods sold was higher. If your cost of goods sold is higher, then the gross profit margin under FIFO would be lower. So if your gross profit margin is lower, then if your gross profit is lower, then the gross profit margin will also be lower, because in both cases revenue doesn't change. And that is the reason why we have a lower gross profit margin, because in FIFO the cost of goods sold is higher, and again this is an unusual scenario because the change in LIFO reserve was negative. Net profit margin. Now net profit margin is net income over revenue. So if you recall, under FIFO, cost of goods sold was higher. If cost of goods sold is higher, net income is lower, and hence again the net profit margin was lower. Return on asset is net income upon average total asset. So net income upon assets. So net income is lower in FIFO. Why net income is lower? Because cost of goods sold was higher, and assets are higher under FIFO because inventory was higher because of LIFO reserve. So both of these effects are lowering this ratio down. Net income is going down, numerator is going down, denominator is going up, so the ratio goes down with it. Current ratio is current assets divided by current liability. Now in FIFO, your inventory is higher, so current asset goes up and current liability doesn't change. So if current asset goes up, then FIFO current ratio will also go up with it. If current asset goes up, your current ratio will also go up with it. Now, total liabilities over equity. So liability over equity. Over here we need to understand that in FIFO, liability would be higher because of this 710. If cash switch to FIFO, it would have an additional tax liability of 710. So liability will go up by 710, and your shareholder equity is also going up by 1214. So the impact would be that the denominator is increasing by a higher amount, and your this current liability to equity ratio is going down. Now we also need to understand that most of the ratios of LIFO, the ratios under LIFO were better, and under LIFO will increase the company's value because the cash flows are higher in early years due to the lower taxes, as we mentioned before. So LIFO is primarily used for tax benefit it provides. And again, in normal scenario as well, the cost of goods sold under LIFO, the cost of goods sold is higher than inventory. If cost of goods sold is higher, then the taxes are lower. That will going to increase your cash flows. If cash is higher, that will going to increase the company's value. And this 1214 is coming from the retained earnings that we calculated, that the amount that would be added to catch retained earning would be 1214 if it had used FIFO instead of LIFO.